Welcome to the Tax Clinic. In our previous episode, we explained what electronic invoicing is and how it operates within the United Arab Emirates' new digital ecosystem. This system serves as the structural foundation, connecting the private sector to the state's financial architecture. It routes millions of daily commercial exchanges into a standardized network, directly affecting how corporate finance departments process their standard payables and receivables across the state. But recognizing the existence of this ecosystem is only the first step. Business leaders must now determine precisely when and where these rules apply to their specific operations. This raises an incredibly important question for everyone. Will every single transaction your business makes be subject to electronic invoicing? The short answer is not necessarily. To understand why, we turn to Ministerial Decision No. 243 of 2025, which specifically defines the exact scope of electronic invoicing. This decision dictates exactly which entities are required to participate, while also detailing the strict exclusions of the system. By utilizing Decision 243, businesses can navigate their compliance obligations accurately without overextending their administrative resources. The decision states that the electronic invoicing system generally applies to persons conducting business in the United Arab Emirates and to the business transactions that take place between them. To simplify compliance, the Ministry of Finance's electronic invoicing guidance organizes these covered transactions into three principal categories. These include business-to-business, or B2B, transactions between two businesses. For example, if a logistics firm bills a local retail chain for warehousing services, that exchange falls squarely into the B2B framework. This category captures the vast majority of standard commercial trade within the UAE market. While B2B compliance secures the bulk of daily corporate operations, modern businesses also maintain critical financial relationships directly with the state. This introduces the second principal category, business-to-government, or B2G transactions. A common scenario here is an IT consultancy issuing an invoice to a federal ministry for completed infrastructure upgrades. The final category is government-to-business, or G2B transactions. This occurs when a government entity issues an invoice or transaction directly to a business, such as a municipal authority executing a commercial land lease to a private manufacturer. These represent the principal categories that fall within the electronic invoicing framework. The system applies to these transactions unless they are specifically exempt under the decision or any future decision issued by the minister. If a business operates in the UAE, its core financial relationships are inherently captured by one of these three structural pillars. However, this does not mean that every transaction is automatically included. Ministerial Decision No. 243 of 2025 establishes strict operational boundaries to the mandate. The decision provides specific exemptions from electronic invoicing. Understanding those exemptions is just as important as understanding the general rule. Knowing exactly where the law does not apply prevents costly overcompliance and protects your operational efficiency. In our next episode, we will explain the most important electronic invoicing exemptions and when the system does not apply. Thank you for watching the Tax Clinic. At Tax Clinic, we simplify tax legislation and turn it into practical business decisions.